Picture two envelopes on a kitchen table. Both arrived on the same morning. One is from the bank. It confirms a fraud investigation is now open on the account. The other is from the mortgage company. The automatic payment scheduled for that morning came back declined. The person sitting at that table did nothing wrong. She did not click a suspicious link. She did not give her number to a stranger on the phone. She used her debit card at the grocery store, the pharmacy, and the gas station. The same three places she has gone every single week for years. And somehow, in the 48 hours between her Social Security deposit posting and the morning those two envelopes arrived, someone she has never met moved most of it out. Here is the question that actually matters, not how the fraud happened. We will get to that. But why was the damage so much worse than it needed to be? Because the fraud itself was recoverable. What the fraud triggered was not. That is what this video is about, not just how debit card fraud works, but why the payment method most seniors use every single day is built in a way that makes the aftermath of fraud far more destructive than the fraud itself. And why your bank, the one with the friendly branch manager and the free checking account, has no structural reason to tell you any of this. By the end, you're going to have a clear picture of what account setup actually protects you. Not the policy your bank printed on the back of your welcome packet, but the real legal distinction that determines how much of this you ever have to live through in the first place. Most people who open a checking account receive a card with it almost automatically. The bank hands it over at the same moment they hand over the welcome folder and the booklet that nobody reads. And it makes sense that they do this. A debit card is genuinely useful. It works everywhere. It comes out of your pocket the same way a credit card does. It requires no application, no credit check, no monthly statement to review. For a retiree on a fixed income who wants to spend only what they have, a debit card feels like exactly the right tool. What is not explained at account opening, not once, not in the booklet, not in the welcome email, is that a debit card and a credit card operate under two completely different federal laws. And those two laws produce two completely different outcomes the moment something goes wrong. When you use a credit card and fraud occurs, the charge is disputed before your money moves anywhere. The Fair Credit Billing Act governs the process. The fraudulent transaction is flagged, held, and reversed while the investigation runs. Your account balance during that entire period looks exactly as it did before the fraud happened. You owe nothing on the dispute while it is under review, and every major card issuer will reverse it immediately upon report. Your money never left. You never lost access to it. When you use a debit card and fraud occurs, the process runs in the other direction. The money leaves your account the moment the transaction is posted. The Electronic Funds Transfer Act governs your debit card. That law gives you protections, and they matter, but the sequence is different. The money is already gone before anyone investigates. The investigation runs while your account sits at the lower balance the fraud left behind. If you report within 2 business days, your maximum liability is $50. Wait between 2 and 60 days, and your liability can extend to $500. Past 60 days, there's no federal floor on your exposure at all. But here's the part of that timeline that does not get mentioned at account opening. The bank does not have to restore your funds while the investigation runs. If the transaction crosses an international border, and a lot of debit fraud occurs because criminals route transactions through foreign processors, specifically because it buys time, that window extends to 45 days, 10 to 45 business days. Think about what is running on autopay during that window. Mortgage or rent, utilities, insurance premiums, car payments, prescription auto refills. None of those billers wait for a fraud investigation to close. The scenario that plays out most often does not involve a data breach at a company you recognize. It does not involve someone phishing you by email or calling to pretend they are from the IRS. It involves a piece of hardware smaller than a deck of cards attached to a gas pump or an ATM that you touched for a few seconds and never thought about again. Card skimming has been around long enough that many people assume it is a solved problem. It is not. The devices have gotten harder to detect, not easier. Modern skimmer hardware can be installed inside the pump housing itself, invisible to anyone looking at the card reader from the outside. And according to FICO's 2025 Card Alert Service data, more than 243,000 debit cards were compromised by skimming in a single year, a number that has been climbing, not falling. The timing of when a criminal uses a skimmed card number is not random. Fraudsters know what they are doing. They wait, they watch card activity to identify when a new deposit has arrived, then they move. A Social Security deposit posts on the 3rd of the month. The fraud charges appear on the 4th or the 5th in the middle of the night at retail locations in another state. The timing is not a coincidence. Here's what that looks like inside an actual monthly budget. A retiree receives $2,100 in Social Security income. After the fraud posts, the account balance is $480. She calls her bank immediately and reports it. The bank opens an investigation. She has done everything right. But her mortgage autopay is scheduled for the 10th. That is 7 days away. If the bank takes the full 10 business days to restore her funds, which they are legally permitted to do, The mortgage payment drafts on a balance that cannot cover it. The payment comes back declined. The mortgage company charges a return payment fee. The bank charges a returned item fee. The utility autopay 2 days later does the same thing. And the insurance premium the following week does the same thing. By the time the investigation closes and the funds return, the fees have stacked. The declined payment notations have been logged with the creditors, and she has spent the better part of 2 weeks on the phone with billers explaining a situation that was entirely outside her control. The fraud itself, the actual criminal act, was maybe a 4-hour problem in terms of what the fraudster did. The aftermath was a 12-day problem, and everything about that aftermath was a function of one specific characteristic. The payment method she used was directly connected to the account her income lands in. There's a reason this conversation rarely happens between a bank and its customers. It is not complicated and it is not hidden. It is just a matter of following the money in a direction most people do not think to look. Every time a debit card is swiped, the issuing bank collects an interchange fee from the merchant, not a huge fee per transaction, but across millions of customers making dozens of transactions a month. Those fees add up to a significant revenue line. The more debit card transactions, the more the bank earns. That fee structure does not disappear when fraud occurs, and it certainly does not motivate a branch manager to sit down with a longtime customer and say, "Here's the payment method in your wallet that carries the weakest legal protection and the greatest potential to drain the account where your income lives." That conversation costs the bank nothing to have, but it reduces the behavior that generates interchange income. So the industry does not build systems that prompt it. There is also the overdraft question. Congress voted in 2025 to roll back rules that would have capped overdraft fees at $5. Banks collected over $12 billion in overdraft and return payment fees in 2025. When a fraud event triggers a cascade of declined auto payments, each one of those declines can generate an overdraft or returned item fee at the bank. Those fees are not a bug in the system. They are a feature of what happens when a primary income account is used as a daily spending account and something goes wrong. This is not a conspiracy. No one is sitting in a conference room designing fraud schemes. It is simpler than that. The incentives are structured in a way that produces a predictable outcome. Seniors using debit cards attached to primary income accounts for daily purchases, and the vulnerability that creates going largely undiscussed until something actually happens. The voluntary zero liability policy that most banks advertise for debit cards deserves a closer look here as well. Those policies exist, and in many cases, banks do act quickly to restore funds. But a voluntary bank policy and a federal law are not the same thing. The Fair Credit Billing Act is a law passed by Congress. Your bank cannot change it on a quarterly earnings call. A bank's voluntary zero liability policy can be narrowed, restricted, or conditioned at any time the bank chooses. It has happened before when fraud losses climbed high enough to make the policy expensive. Relying on a voluntary policy instead of a statutory protection is a different kind of risk than most people realize. Let's set aside the stories for a moment and look at this as plainly as possible. Your debit card gives a criminal direct access to your checking account, not a credit line, not a pending authorization, the actual balance in the actual account where your income deposits every month. The moment a fraudulent transaction posts, the money is gone. Your bills, your auto pays, your financial obligations, they do not pause while the bank investigates. Your credit card gives a criminal access to a disputed line item. The money never moves while the dispute runs. The Fair Credit Billing Act requires the issuer to investigate before your balance is affected. Every major issuer extends zero liability as a matter of both policy and practice. The account you actually use to pay your bills never sees fraud at all. Those two descriptions apply to two cards that look nearly identical in your wallet. Same size, same chip, same tap-to-pay function. One of them is governed by a federal law written for an era of direct electronic access to bank balances. The other is governed by a federal law specifically designed to put the dispute process before the money movement. The protection gap between them is not marginal. It is structural. And the single most effective thing any retiree can do to close that gap does not require a complicated financial plan or a new service or a paid subscription to anything. It requires one phone call and understanding one principle. The principle is account separation. Your primary account, the one where your Social Security check deposits, where your pension lands, where your investment distributions arrive, that account should face the world as little as possible. No debit card attached to it should ever touch a merchant terminal. Its number should appear on as few screens and as few physical card readers as possible. That is the account your automatic payments run through. That is the account your income lives in. It should not be the account that goes anywhere near a gas pump. Here is what account separation actually looks like in practice. It is not complicated, and once it is in place, you essentially stop thinking about it. You keep your primary account exactly as it is. Direct deposit, automatic payments, the works. You do not cancel your existing debit card on that account. You simply stop using it at merchant terminals. You keep it for ATM withdrawals at your own bank's machine where you are withdrawing your own cash and not presenting your card number to a merchant system. That is one of the few situations where a debit card is still the right tool for the job. Then you open a second account at the same bank or a different one. Most banks allow this with no fee on basic accounts. This becomes your spending account. It gets its own debit card and you fund it with a modest amount on a regular schedule. Put in what you plan to spend next week. $200, $300, whatever matches your routine weekly spending. You use that card at the grocery store, the pharmacy, the coffee shop, anywhere you would have used your primary card before. If a skimmer captures that card number at a gas pump, the criminal gets access to what is in the spending account, not your monthly income, not the account your mortgage payment drafts from. Whatever you put in that account for the week. A problem, certainly, but a recoverable one on a scale that does not collapse your monthly budget. If you're comfortable with a credit card, a better version of this setup replaces the spending account debit card entirely. You use a credit card for every purchase. You pay it in full on the due date each month. You pay no interest. The Fair Credit Billing Act covers every transaction automatically, and your checking account, the one your bills run through, never appears at a merchant terminal in your life. A fraudster who skims a credit card number is working against a federal law. A fraudster who skims your primary debit card number is working against your monthly budget. The two-account debit setup and the credit card approach both arrive at the same place by slightly different routes. There is a wall between your income and the world of merchant card readers. That wall is what determines whether a fraud event is a 4-hour inconvenience or a 12-day cascade. There are 4 situations where a debit card remains the right choice, and it matters to be specific about them rather than treating the card as something to avoid entirely. ATM withdrawals at your own bank's machine are the clearest case. You are withdrawing cash. You're not presenting your card number to a merchant network. Use your body to shield the keypad when you enter your PIN. And before inserting your card, take a moment to check whether the card slot looks the same as you remember. A legitimate card reader is firmly attached to the machine. If anything moves when you press on it, go inside or find a different machine. Small local businesses that do not accept credit cards are a reasonable exception. Use the spending account card, not the primary account card, and pay the minimum needed for that transaction. Government payments and utility bills that charge a convenience fee for credit cards, typically 2 to 3%, may make more sense on a debit card depending on the amount. On a $200 utility bill, a 3% credit card convenience fee is $6. If the same payment posts for free using a debit card, it makes sense to use the debit card. Use the spending account card. And any business that offers a cash or debit discount, same rule. Spending account only. Outside of those 4 situations, the debit card attached to your primary income account has no business being at a merchant terminal, not because debit cards are defective products, but because the federal law that governs them was written when electronic transactions were newer and the fraud landscape was simpler. The same card that made perfect sense in 1990 carries a different risk profile in 2026, and knowing that difference is the entire point. There are a few things that cost nothing and can be set up in a single phone call. Real-time transaction alerts on every account with a debit card. Not a daily digest, an individual notification the moment any transaction posts for any amount. If a fraudulent charge is posted at 2 hours in the morning, you know at 2 hours in the morning, not when you check your balance 3 days later. Call your bank today and confirm this is already active. If it is not, ask them to turn it on before you hang up. A daily spending limit lower than your bank's default. Most banks set debit spending limits somewhere between $500 and $1,000 per day. Ask them to lower it to $200 or $300. You can always call in to authorize a larger planned purchase. A criminal who gets your card number in the middle of the night cannot run through $900 in 4 states before sunrise if your daily limit is $250. A habit of checking your account every 3 to 4 days, not monthly. The 60-day window in the Electronic Funds Transfer Act sounds generous until you realize how easy it is to reach day 61. 3 minutes every few days, scan the last 10 transactions. Anything you do not recognize, call immediately. And a rule for gas stations, pay inside or use a credit card at the pump. Not because gas station skimmers are a rumor, but because they are among the most documented sources of debit card fraud and data the FTC publishes every year. The pumps sit unattended. Modern skimmer hardware installs inside the pump housing where no external inspection finds it. A credit card at the pump costs nothing extra. A debit card at the pump is the single highest risk swipe in most people's weekly routine. Go back to that kitchen table at the beginning of this, the 2 envelopes, the fraud notice, and the declined payment. The woman sitting there did nothing reckless. She used her card the way the bank encouraged her to. She did not click anything suspicious or answer any dangerous calls. She went to the grocery store. What she did not know, and what no one at her bank sat down to explain, is that the card she used to buy groceries was connected by a very short wire to the account where everything she depended on lived. And the federal law governing that card does not build a wall around the money before the investigation starts. It starts the investigation first. The setup that changes that outcome is not dramatic. It is an account you open with a phone call and fund every week. It is a spending limit you lower with a single request. It is a credit card you already may have sitting in a drawer that could handle every merchant transaction you make without your primary income account ever appearing at a terminal again. The gap in protection between these two payment methods has been there for decades. It is a gap built into law, not into any particular bank's bad intentions. But knowing it is there is the difference between being prepared for it and finding out about it at a kitchen table with two envelopes.